All right, hello and welcome to the last of this recent series of webinars. Today's topic is a catch-22 of investing, novel but certain to succeed. And I'll clearly explain what that is. As always, these webinars are brought to you by Fledge and Aviary. A little bit about me before I get going. So my name is Looney Libis. I am a 25-year serial entrepreneur turned investor. I spent the first 20 years of my career in the tech space, growing venture-backed tech companies, and then shifted over 4.5, almost 5 years ago now, to work in the space of doing good and doing business at the same time, or doing good by doing business. I learned that at a school based here in Seattle called Pinchot University, and from that learning, created Fledge, the Conscious Company Accelerator, and this year spinning up a venture seed fund called Aviary. All right, so today we're going to do a lot of ABs. We're going to have two columns. Left column is A, right column is B. And the question is, if you were an investor, so put yourself in the shoes of an angel investor or a small venture capital fund, but let's just stick with angel investor. Which would you choose, column A or column B? All right, and so we're going to do this with real companies. And so here's the first two choices. Would you rather invest in A&R Solar, which is, I believe, the largest solar installer in the state of Washington, or Solyndra? And let's just say this is a few years ago, because I'll give you the punchline, which is Solyndra went out of business. All right, so A&R Solar is a solar installer. You call them up, they'll put solar on your house. In fact, 12 feet above me are some solar panels that they put in last year. And Solyndra is a new solar technology, or was a new solar technology that was creating solar panels that were cylindrical in nature. That's kind of a play on the name there. All right, and I don't actually know the numbers for A&R Solar, but it's probably around 10 million in revenues. It's a profitable company, that I know. It does a whole lot of solar installations. Whereas Solyndra, at the same moment in time, a few years ago, had about $500 million in funding. They were one of the poster children for President Obama's and the Department of Energy's loan fund, right? Guaranteed loan fund. A few years ago, they were just coming out of R&D. They were just starting to sell their products. And meanwhile, A&R Solar at the same time was installing solar panels, flat solar panels, on roof after roof after roof. And so the question is, if those were your two choices, if those were the two companies presenting to you and you were in the mood to invest in solar, which kind of company would you invest in? And I'll tell you, in terms of venture capital investing and angel investing, the company on the left is considered not an investable company. It's not a scalable company, is how they would talk about it. Because if you want to install twice as many solar panels, you need to buy twice as many trucks and hire twice as many people. And so the scalability of the revenues and the profits of A&R Solar is totally dependent on the employment of A&R Solar, and that makes it less investable. Meanwhile, Solyndra is the type of company where giant, Walmart could come in and say, okay, we're going to put these on the top of every roof. And yes, they would need to build more factory out, but they wouldn't have to hire many more people. They wouldn't have to double the staff to double the output, right? Automated production and all that. And so that's the kind of company that can scale up and become very large. And so that's the kind of choices that investors make each day. So let's look at some more of these. Let's look at wallboard. Here's a nice boring business. The largest wallboard company, or one of the largest wallboard companies in the United States, is called National Gypsum. I looked them up, never heard of them before. They have 21 factories in the country. They are a highly profitable company. Happens to be private. You can't buy their shares on the public market right now. But nonetheless, let's just skip over that part because you can't buy Vigorous Materials either. They're a brand new company, just graduated from Fledge. They have the design for a better, greener wallboard. It does everything better than gypsum wallboard. They are ramping up into production. They have not sold a single board of wallboard yet. And so which of these two would you choose if you had the choice, right? Would you go with the company that definitely knows how to build wallboard, builds it every day, knows exactly how much profit they make, and probably does maybe 1 or 2% growth per year? Or would you choose the company that has a better product, that will be in the market that may be the size of National Gypsum in 20 or 30 years, but right now has not sold a single thing. All right, let's do one more. On the left, we have Charlie's Produce. This is the largest distributor of fruits and vegetables in Seattle. Again, you can't buy shares in the public market. It's a private company, but we're going to skip that. And when you go to their website, you discover that they're not only here in Seattle, that they have production or distribution facilities in Los Angeles and Portland and Spokane and Anchorage and a couple other smaller cities as well. Or choice B is East Africa Fruits. So this is a 3-year-old company in Tanzania, just an hour outside of Dar es Salaam, the largest city in Tanzania, and they are distributing and processing fruits and vegetables in their home country of Tanzania. And again, they are a fledgling from about 18 months ago. Charlie's is on the order of 1,000 times larger in terms of revenues and profits. East Africa Fruits has almost no competition in an entire country of 40 million people to go serve, as opposed to Charlie's, which has, I don't know how much competition they have in LA, but here in Seattle, they have 4 million people to serve. So why would you make the choice you would make? Right? So I'm not going to ask you you can put it in the chat window if you want, which one you would choose. But the big question is, why do the ones on the left seem totally different than the ones on the right? Why is there a huge difference in these types of choices? And there's 3 answers here. Right. So first and foremost, when you talk to angel investors, they're mostly choosing to be angel investors because of the excitement and the opportunity of investing in startups. And so if you talk to someone who has been an angel investor for a while, or just starting to be an angel investor, they'll most likely pick column B. In all cases, they'll pick the company that is more innovative, more exciting, and has the larger opportunity of growth in front of it. Then again, if you talk to someone who was an angel investor in the past or has 10 or more years of being an angel investor, they may start to show their risk aversion and say, well, I did a lot of bets on companies like those, and most of them went south. And therefore, I would rather invest in a company like A&R Solar, where I know they're going to make profits. I know that when a customer calls them, every time a customer calls them, they will make profits on that install. It won't be a huge percentage, and no, the company won't be 10 times larger in a few years, but they will make profits and they can pay me back, right, in whatever form the investment comes in. Same thing with National Gypsum. There are a few public companies that make wallboard, and if you would like to buy a blue chip, if you would like to make sure that your money is still there in 10 years, you may choose to invest in a company like National Gypsum. And same thing with Charlie's. Right? Maybe Charlie's will go public one day. Of course, the third choice, right, in terms of investors, the third choice, and maybe the most important choice, is how much money am I going to make back on this investment? Right? Investors invest for the primary reason of making money. A lot of the previous webinars talked about impact investing, where we mix that together with having a mission. But nonetheless, the definition of investor includes return on investment. And so you have to look to the future to figure out which one's going to be the better investment. And so in order to look to the future to figure that out, we have to actually look at the past. So let's look at a couple other A/B examples. So let's presume now, let's put ourselves in the shoes of an angel investor in 1996. Right? That seems, to me, that doesn't seem so long ago, but that is 20 years ago now. All right, so it's 20 years ago. You have 2 choices. You're at the top of the list of choices, and here's 2 in front of you. On the left, we have a company called America Online, which is, of course, an online information service. 96, the internet's about 4 years old, if you forget that. And on the right, we have a brand new company called Amazon.com. Right, got started about 18 months ago, if we're in the end of 96. America Online is 13 years old already. Their service that we know of as this dial-up service is about 3 or 4 years old. They're doing $1 billion in revenues in 1996. They have 5 million subscribers, and they're adding 200,000 or 300,000 subscribers per year. Right, it's growing pretty fast. Meanwhile, this choice B is this brand new bookseller on this brand new thing called the internet. They're in their second year total. At the end of 96, they did 16 million in revenue that year, up from $1 million in revenue in their first full year, which is 95. So which would you choose, right? If you're, again, looking at the future, it sure seems like America Online has much more of a future than this bookseller. It sure seems like they're a big established company and they know what they're doing versus this bookseller. And yet, in hindsight, if you were to hold that investment for 20 years, you would have done way better on the right side. Same thing 3 years later. So let's just put ourselves in the shoes of 1999. The internet bubble is nearing its peak, right? It peaked in March of 2000. So let's just say it's the end of 99, or the beginning of the onset of the millennial. And here's two choices. So on the left, we have a fairly new company, but has been growing like gangbusters. It's called Yahoo. Right? They were founded 5 years ago. They did $588 million in revenue. They were catching up to that other darling, AOL. That was $588 million. It was pretty much all in ad revenue. And they had just started using this new search service. It was on their site. It was Yahoo Search powered by Google. Google was just over a year old, and they had no revenues. In fact, they had no business model whatsoever. They had not just no revenues, they were not even asking anyone for money. And here we are at 99, and which one would you choose? And again, why on earth would you choose this new Google company that didn't even know how to make money? And yet, not quite 20 years later, it's pretty clear, right? Yahoo just got basically their assets got purchased because it hasn't been working. Right? They're up to $4 billion in revenue, and Google's in the double-digit billions. Right? So there's something to this idea of the novelty on the right side. So what do we learn from looking backwards? Well, two things really. One thing is that innovation can equal growth. Right? So the Amazons and the Googles, and in fact the AOLs and the Yahoos, earlier in the path there, shows that it is possible that the innovative companies hit on something that can be huge, and huge in terms of market size and revenues and profits. Right? So Google is the third most valued company in the world at the moment. Right. For example, if we look at Amazon from the moment they went public until today, versus the disruptor of the 19th century, which is Sears, right, the retail disruptor, you can see that you would have earned 51 times your money back if you bought Amazon on day one when they went public, and if you owned Sears, and it looks like Sears did a little reorg in 2003. But if you owned Sears from that day, you would have lost 4% of your money. So that is really what the innovation and the excitement and the potential return is on one of these disruptive high growth companies. Same kind of thing in the car industry, right? So Tesla versus GM. If you bought Tesla on their first day they went public, you would have made 1,000 times. Oh, sorry, that's 100. You would have made 10x your money back, right? 1,000%. Whereas if you bought GM on that same day or the day they fixed their bankruptcy issue, which was soon after that, you would be down 8%. Same kind of business. In this case, like totally head to head. Tesla and GM both build cars. Their vehicles both do the same thing. GM has some trucks built mixed into that mix. When we look at the market caps, you can see that investors, and even in the public market, investors value innovation. So Tesla today or yesterday had a market cap of $31 billion based on $5.7 billion in revenues, and they've never made a profit ever. So just based on their revenues, about 5.5 times revenues is their market cap. Whereas General Motors has a market cap bigger, which makes sense, right? They've been around longer. They make a whole lot more money. So they have a $49 billion market cap. They made $158 billion in the last year, and they had $18 billion in profits. Right? So their profits were half the value of Tesla. Right? But they're valued at less than a third of revenues is their market cap, or the normal way to do it is to look at the price earnings ratio. So it's what's that, 20 million in profits to market cap. So a small multiple of profits to market cap, and you can't do that with Tesla because they don't have any profits. All right, the other lesson that we should learn from looking at the past, looking at AOL and looking at Yahoo, is that innovation often means failure as well. So I showed you a couple success cases, but what I didn't show you was all the companies that went public and then disappeared, such as Enron, right? Remember that one from 2001. There's a company that had a really nice run for quite a while. And then due to some fraud that was due to the fact that they were in fact failing internally, right, that what they were doing wasn't actually working, their stock price went to zero. And so it is totally possible not only for a startup to not find traction and not find customers and fall off the cliff, it's possible for a public company to grow and grow and grow and then all of a sudden not. There's a few other examples too. If we go back to the dot-com bubble, one of the poster children is pets.com. They were selling 40-pound bags of dog food with free shipping, losing money on every sale, trying to make it up in volume, which doesn't really work. Or the other poster child is Webvan, which spent about $200 or $300 million before they launched the product. And then it turned out that nobody wanted that product, or very few people wanted that product. They were delivering groceries to homes, which is something people still talk about and Amazon still tries to do. But pretty much no companies figured out how to do that profitably. And one of my favorite stories is this weird little thing you may have had called a QCat. They also spent about $200 million bringing it to market, and they could have found out much sooner that nobody really wanted it. All right, that really is that idea of bringing things to market that no one wants. That is the venture capital model. Right? And I talked about this in the first webinar. This is an indicative portfolio of a successful venture capital portfolio. I'll say that again. So this breakdown here of what each 10 investments should look like. This breakdown is what a successful venture capital portfolio would look like, and I'll just walk through that. So what that means is a given venture capital fund will typically make 15 or 20 investments in the lifetime of the fund. In 5 years of investing, they'll only make 15 or 20 investments total. Right? So per 10 investments, one of those will be a hit. So a successful venture capital fund that put money in AOL, that would have been a hit because they made way more than 10 times their money before they went public. Same thing with the Yahoo venture capitalists. Whatever venture capitalists are in Tesla have made money because it went public. But all the venture capitalists that put money into pets.com and into Webvan and whatnot, well, they may have gotten single-digit money back. They may have gotten a single on that, which is 3 out of 10. So out of 10 investments, 1 out of 10 needs to be a 10x or greater. 2 will be okay. There'll be a 2x, 3x, 5x, 7x, something like that. That's considered okay, but not great in venture capital world. 3 out of 10 will just return their money. And really, most of the time, that is exactly what money they put in because there's a detail in their contract that lets them have their money back at some point. And 4 out of 10 will be a failure. Total zero, total failure, write it off the balance sheet. So if you just look at the bottom 2 rows there, you get 7 out of 10 that don't really return anything besides the original capital. Right? And if you don't return capital in 10 years of being a venture capitalist, you've lost money for your investors, right? Because they could have just put it in the savings account and made more money than that, or clearly the S&P in any 10-year period would have returned them more than 1x their money. And so 7 out of 10 times, this is kind of the key takeaway on this picture here, is that when professional venture capitalists make investments in startups, 7 out of 10 times they're wrong. That only 3 out of 10, only 30% of the time are they able to pick a successful investment. And so this is where the failure comes in the venture capital model, is most of the time they're wrong. Most of the time these startups are failing on them. And it's a minority of cases where they're making money on their investments. Right? Those are making up for all the differences because the returns are so high. But nonetheless, the professionals can't pick the companies either, right? And it gets worse than that. So if you look at the breakdown within the venture capital industry, there are a few hundred venture capital firms in the United States right now. At the peak, there were about 700. There's a lot fewer because most of them don't succeed. And so if we look at the chart on the left, what that's showing is that the top 20 VC firms are just a sliver at the bottom of the total number of VC firms, right? It's less than 10%. But those top 20 firms make basically all the profits. That more than half of the venture capital firms do not beat the S&P 500. In fact, more than half of the VC firms don't even return the equal capital back to their investors, that they lose money for their investors. And so what I'm trying to teach in this webinar and in my other webinars is that you don't need to follow their lead. You don't need to make the mistakes that the VCs make, that there are other ways to invest. And so in the first webinar, a few slides I'm going to repeat from there, that there are about 500,000 startups per year in the United States, but the VCs only fund about 2,000 new companies per year collectively. And so that is less than 0.5% of all the companies. And they only invest in less than 0.5% of the companies because mostly they say they're uninvestable, that they're not scalable companies, that they're too much like the companies that I started with on the left, right? The A&R Solars and the Charlie's Produce, right? Those aren't VC investments. They would never pick those. Of the companies they invested in, last year there were 275 exits. So if you go back in time, 5, 6, 7, 8 years, you'll find that they invested in about 2,000 companies back then as well. And 275 of those exited last year. And so again, of the other 1,700 and change, well, most of them are out of business. A few of them are still running, hoping for an exit in the future. But this number of 275 per year is pretty indicative of a normal year. And so again, most of the companies out there, the 500,000 startups, less than 0.5% or less than 0.1% actually succeeded at the venture capital model and had a good exit, had an exit worth writing about in the newspaper. So in the VC model, I'm going to drive this home one more time. They'll say that 99% of all startups, or 99.5% of all startups, are uninvestable. And yet of the investable companies, 86% of those are failures, right? Which is just terrible numbers when you look at it. There are other ways to do this. Given the right investment structure, every one of those startups is investable. And by investable, I mean that you could, as an investor, put money in them and get more money back out. That it would be a win-win for the company to have investment dollars into it, and it would be a win to the investors to have their money come back out and then some. To hear how to do that, you can go and listen to the first webinar, which is called You're Doing It Wrong, Investing in Startups Without Waiting for Exits. And any other webinars that I've done in the past six weeks. And they're all on aviary.vc/webinars. And the reason they're up there is that Aviary VC is a new impact seed fund that is a venture capital fund in the regulatory sense, but we'll be using the techniques that are described in that first webinar in order to invest in companies that would otherwise seem uninvestable. Right? In fact, Aviary's plan, it's still raising money right now. If you're an accredited investor, feel free to reach out to me. But Aviary's plan is to invest in the best of graduates of Fledge, the Conscious Company Accelerator, and accelerators like Fledge that work with socially and environmentally conscious companies. To explain a few more of those before I stop recording and take questions, there are 55 graduates of Fledge in total. Some of the ones that are on the scale of less novel and more certain, that are unlikely to return 10x returns, would be like African Chicken, which is growing chickens in Tanzania with smallholder women farmers. Brent Oils, which is recycling motor oil in Kampala, Uganda. Burn Manufacturing, which is making cook stoves that look like that in Kenya. You can see a lot of these are in the developing world. Cropital is a crowdfunding site in the Philippines for farmers. I mentioned East Africa Fruits already. Giassi is a fish farm, also in Uganda. But that's not all we've picked in Fledge. We have 3 companies. I'll talk about 2 that are incredibly innovative. Right, Vigorous Materials will be the 3rd one on this list. Incredibly innovative, completely uncertain future, potentially huge rewards. Right, so 2 of them are on the left. We have Evernew. They're a clean tech company in the fashion industry. They have a technology to take used clothing that has no more use to it, break it down, spin it back into fiber, and turn it back into clothing. First product they're doing this with is cotton, and their first customer, that is a picture of the first pair of recycled Levi's jeans. They took old jeans, basically dissolved them down, respun them into fiber, turned the fiber into fabric, dyed it blue, and Levi's cut and sewed it back into a pair of 511 jeans. First time in the history of mankind we're recycling clothing. And on the right is a company from Argentina that was at Fledge last year called ArcLight. They take any plastic waste, melt it down, squeeze it into artificial stones that are used as a replacement for quarry stone and concrete. So these are the kind of companies that could make huge dents in the world and or fail miserably. We'll find out. And so you can see again, which of those types of companies would you pick? My answer is you should, my answer is coming up, which is we started the webinar by asking which would you choose, A or B? And the true answer in terms of novel but certain is that you should choose a little bit of A and a little bit of B. That you should have a portfolio that includes a bunch of investments that will pay you back or most likely pay you back. But at the same time, there are innovations out there, and you should mix in a few of those because if they succeed, they A, could truly change the world and make it a better place, and B, at the same time, make investors a large sum of money. And so with that, I will take your questions.